I am Dr. John Bergduff. In this video, we're going to learn how to calculate the payments on a loan. The formula on your left shows how you calculate the payment on a loan given various information. P is the principal, that's the amount that you borrow. R is the annual interest rate that you're paying. N is the number of compounding periods and payments per year. The assumption is that the interest is compounded at the same periods as the payments are made. T is the time in years, and then the formula will give you PMT, which is the payment. And I'm going to show you how to use your graphing calculator, your TI-84 graphing calculator, to do this calculation all at one time. So here's a simple example. You borrowed $20,000 to buy a new car with a 5-year loan at an annual interest rate of 6.5% compounded monthly. What are your monthly payments? So let's see what the values of all these variables are. First of all, P, that's the amount, that's the principal, that's the amount that you borrow, that's $20,000. R is the interest rate. That has to be converted to a decimal. So 6.5% is the same as 0.065. N is the number of compounding periods and also the number of payments per year. We're talking about monthly payments, so that would be 12 in a year. And T is the time in years that the loan extends over. This is a 5-year loan, so T is 5. Now we will plug into this into the calculator to get the exact value. The good news is, because your TI-84 calculator knows the order of operations, basically you enter this exactly the way it looks and you will be fine. So let's start with the numerator. First of all, we have P, that's 20,000. Open parentheses, R divided by N, 0.065 divided by 12, close parentheses, and that's everything for the numerator. So to get the denominator, we divide, and everything in the denominator, as the formula shows, will be in parentheses. The formula indicates two shapes of parentheses to distinguish the inner from the outer, but we really can get by with just the round parentheses as long as we're careful to include everything. So in parentheses, we have 1 minus, and then open another parentheses, 1 plus R, which is 0.065, divided by N, which is 12, close the parentheses. Then you need an exponent. The way you get an exponent on the graphing calculator is to use the caret button, which looks like a little hat right here. You'll see that that elevates the cursor up into an exponent. In the older calculators, the older TI calculators, this would not go into an exponent, and you have to have parentheses to indicate what you want to keep in your exponent. That is actually still a good practice, even for the newer calculators, to keep everything that you have in the exponent in parentheses. So I'm going to open the parentheses for the exponent. This formula has a negative in the exponent. Use this button here to create a negative rather than the one that would indicate a subtraction. So negative, and then N is 12. Times T, which is 5, close the parentheses, that finishes the exponent. We want to get out of the exponent. This right arrow on the little collection of buttons that look like a wheel will get you out of the exponent, and you still have to close the parentheses. These are the square parentheses. Now everything you see here is exactly the way it would look when you enter this exactly as it looks into the calculator. So we can hit enter and we will get our calculation, $391, and rounding that off to the nearest cent, that would be 32 cents. Actually, what a bank is likely to do, because 32 cents, as you could see, would get you just a little bit short at the end, the bank is very likely to, or whoever you're borrowing from is very likely to make that payment $391.33. Even though the rounding would say 32 cents, the 33 cents make sure that you do have enough, and the bank would probably reduce your final payment just a little bit to make it come out exactly right. If you're doing this as an exercise in homework somewhere, make sure you look at the directions in your homework assignment to see how they want the answer rounded off. So your payments would be $391.33. Now here's the follow-up question. Once you've paid off your loan, how much had you actually paid in interest? So obviously you paid interest for the privilege of taking out this loan, but what is that? How do you figure out what that is? There's actually no particular formula for that. However, you can just logically think it through and realize what it would be. What you have done is you have paid $391.33 12 times a year for a course of 5 years. So if you take $391.33, multiply it by 12 and multiply it by 5, what that would tell you is the total amount of money you made in payments. These are the checks you wrote. This is the automatic withdrawals from your bank, whichever the case may be. Let's figure this number out. 391.33 times 12 times 5. This represents the amount of money you have actually paid over the course of the 5 years, $23,479.80. But wait, what you borrowed was $20,000. You're paying back $23,479.80. The difference represents what you have had to pay in interest. So your interest is going to be whatever you would get when you take $23,479.80 and subtract off $20,000, sorry. And actually, I don't even think we need a calculator for that. That's a pretty easy calculation. What you have paid in interest is $3,479.80. So there you go. I'm going to do one more example that's needs some caveats to explain it just a little bit. The same formula can be used when looking at a mortgage with a couple of comments. The most common form of a mortgage to buy a house is a fixed rate mortgage. That's a mortgage where the interest rate remains the same throughout the entire time of the mortgage. There are adjustable rate mortgages where those interest rates vary based on the market, and the calculations on those are a bit more complicated. But if you have a fixed rate mortgage, you can use this formula to calculate your principal and interest. Now, principal and interest payments do not cover everything that you write a check for when you buy a house. There's also something called an escrow, which I will just write down the word here so you can see it. Escrow payments cover homeowners insurance and property taxes. Those are added on above and beyond the payments that you make just to cover your principal and interest. This formula will not help you with that. This will only tell you what you owe on principal and interest, and then whatever those costs are have to be added on. And it's important to remember that they're going to be added on if you're going to buy a house. But to just get the payments for principal and interest, the same formula can be used. We take $190,000 for my payment. We take an interest rate of 0.04. For a mortgage, the number of compounding periods, that's usually 12. And the time is often quite long. That would be, in this case, 30 years. Let me actually go grab the formula so we can have it close by to see it. Let me just copy it and paste it right here so we don't forget it. There. So let's enter this into our calculator and see what this is going to give us. And as you see, I've got a follow-up question for this one too. Clear this out. So starting in the numerator, we would say 190,000, open parentheses, 0.04 divided by 12. Then that's the end of the numerator. So we're dividing by everything in the denominator must stay in parentheses. 1 minus, open parentheses, 1 plus 0.04 divided by 12, close the parentheses, raise to an exponent, keep the exponent in parentheses, negative n, which is 12, times 30, close the parentheses, get out of the exponent, close the final parentheses, enter. And the payments, your monthly payments just for principal and interest would be $907. And this legitimately does round up, so there's not any question here, to $907.09. And remember that escrow, which is for, again, for homeowners insurance and property taxes, will be added on top of that. Well, here's an interesting calculation. There's your payment. That's what you would have to pay. Once you've paid off your loan, how much interest had you paid? Same calculation as before, just bigger numbers. We are paying $907.09 per month, but that's multiplied by 12 months of the year and 30 years. That would give you an entire amount that you have paid of 7.09 times 12 times 30. This is what you have, the total of all your checks that you have written over all those years is $326,552.40. Only $190,000 goes to pay off your principal. So your interest that you have paid is going to be the difference between $326,552.40 and $190,000. Let's see what that is. Actually, I can, well, let's see, $326,552.40 minus $190,000 you had originally agreed to pay for the house. This is how much you paid in interest. These mortgages, the interest can be rather impressive, $136,552.40 in interest. So I hope you'll find that helpful. Thank you very much.